Well, consumers are feeling slightly less confident. The Conference Board's Consumer Confidence Index coming in at 97. That was below the street's expectations. It's no surprise that investors are feeling a bit less optimistic about the economy as millions of Americans remain frustrated over higher prices because of stalling inflation. Now, with the central bank kicking off its two-day policy meeting today, investors are waiting to hear how the Fed is interpreting the most recent data. For more on this, we want to bring in Brett Ryan, Deutsche Bank's Senior U.S. Economist. Brett, it's great to have you here. So talk to me just about what you're expecting to hear from Fed Chair Jay Powell tomorrow and whether or not we could, in fact, maybe get a slightly more dovish tone than what the market is anticipating at this point.
I think it's difficult to get a more dovish tone, particularly with the latest ECI data. We expect the reaction function to be clarified in the forward guidance language. So I think the Fed wants to, let the market know that further rate hikes are not on the table right now, that elevated inflation would be met with holding rates steady. So I think the guidance language is changed in a more hawkish direction to indicate that they're going to be on hold for longer until they see progress. But there's not much for the Fed to hang its hat on in terms of the recent inflation data. As you noted, the ECI basically year-over-year growth stalled out at 4.2%. That's well above where it was prior to COVID. And so, remember, that was one of the series that really touched off their hawkishness in 2021 when they saw that ECI print surprise. And that really kicked them into the tightening cycle at that time. So, I think it's difficult for them to really give a dovish message or, even to kind of speak to more dovish points. I mean, if there's one thing that they could possibly mention is as you mentioned, is the labor market. And with today's confidence numbers, one of the interesting ones was the deterioration in jobs plentiful, jobs hard to get, because that often portends turns in the unemployment rate. So that's something to pay attention to.
Well, talk to me about this data in aggregate, because one thing I'm noticing in this consumer data we just got is that expectations for the next 6 months are lower because of particularly labor market conditions. But then you've got this ECI showing that we have 4.4% increase in wages and salaries. What is this bifurcation telling you? And does it indicate to you that we have a tale of two different consumer experiences in our economy right now?
Well, I'd say, consumer spending has been divorced from consumer confidence for pretty much the post-pandemic period. We never regained the highs from consumer confidence or University of Michigan consumer sentiment, the pre-COVID highs. We never even got back there. Yet spending has been robust. You've had 2.5% core personal consumption expenditures in Q1. And so, and good spending in particular has remained stronger than the pre-COVID trend. So there's been a sort of a dichotomy between what consumers are saying in these surveys and what they're doing. But I think the important thing to follow is definitely the views in the labor market, because right now what's supporting spending is labor income growth. And when you take payrolls, wage growth, and hours worked, you're looking at 6% nominal year-over-year growth in income, basically. And that's what's supporting spending. If that deteriorates, if consumers are feeling more concerned about the labor market, which today's jobs plentiful, hard to get data would point to, then that would be a concern about spending going forward.
Josh, should we be talking about a potential hike here? Is that in the realm of possibilities?
No, and I think the Fed's going to avoid, any sort of references to that. I'm sure Chair Powell's going to get that question, and his answer is likely to be, we're not. That's not a discussion on the table right now. We think the policy rate is appropriate, and providing the restriction to keep putting downward pressure on inflation. The recent data have been, unfortunate, but. It shows that they have more work to do.
Brett?
Yes.
Sorry, just jumping in here, but why, though? When you take a look at the recent data trends that we've gotten out, you take a look at the recent inflation numbers, solely just this trend that we have been seeing, why shouldn't it be potentially on the table?
Because what you're seeing right now is a stalling out in progress and not necessarily a reversal of that progress. So if inflation was re-accelerating, if you saw the year-over-year rates starting to clearly move back up in core PCE inflation, I think you'd have a problem. Same thing with the ECI. You're seeing a stalling out of progress, not necessarily a reversal of that progress. If the reversal starts to become apparent over the next 3 to 6 months, then hikes have to be brought back on the table.
Well, regardless of the thinking on that, Brett, Jay Powell is certainly going to be pressed on whether or not a hike is on the table tomorrow. Do you think we're going to get an answer from him?
No, definitely think he's going to try to avoid that at all costs. I mean, they made this clear. I think Vice Chair Jefferson and Chair Powell, right before the communications blackout period, they basically said that persistent elevated inflation would be met with holding rates steady and not with rate hikes. So they wanted to make sure that the market wasn't going to start pricing that option in. The thing is that guidance can only last so long. So, he may another couple or 3 bad months of inflation data, and then they are going to start to have that conversation. But Powell doesn't want to get into hypotheticals. He's going to stick to the messaging that the committee firmly believes that the current level of restriction is appropriate. It will continue to put downward pressure on inflation, over time.
All right, Brett, we're going to have to leave it there, but thank you so much for joining us this morning. That was Brett Ryan, Deutsche Bank Senior U.S. economist. Really appreciate it. Thank you.